When Asia's currencies collapsed, the crisis that reshaped global finance. In 1997, a sudden collapse of currencies in Thailand, Indonesia, and South Korea triggered one of the most severe financial crises of the late 20th century. What began as a speculative attack on the Thai baht rapidly spread across East Asia, exposing deep structural weaknesses in fast-growing economies and permanently altering the global financial system. The spark: Thailand's baht crisis. The crisis began in July 1997, when Thailand was forced to abandon its fixed exchange rate, linking the baht to the US dollar. For years, Thailand had enjoyed rapid growth fueled by foreign capital, much of it short-term and dollar-denominated. However, excessive lending to the real estate sector, widening current account deficits, and weak financial supervision made the economy vulnerable. As investor confidence eroded, currency speculators attacked the baht. Thailand's foreign exchange reserves proved insufficient to defend the peg, leading to a sharp devaluation. The baht lost more than half of its value, banks collapsed, and Thailand was forced to seek a USD 17 billion bailout from the International Monetary Fund, IMF. What appeared to be a national crisis soon became regional. Indonesia, economic collapse. Political Indonesia suffered the most devastating consequences. The rupiah, initially allowed to float, entered a free fall, losing nearly 80% of its value within months. Indonesian corporations had borrowed heavily in foreign currencies without adequate hedging, leaving them unable to service debts as the rupiah collapsed. The economic crisis quickly turned into a social and political one. Inflation surged, unemployment rose sharply, and shortages of basic goods triggered widespread unrest. In 1998, amid mass protests and riots, President Suharto's three-decade-long rule came to an end. IMF-mandated austerity measures, including subsidy cuts and bank closures, were widely criticized for deepening social hardship and political instability. South Korea, a near miss for an advanced economy. South Korea's crisis shocked the world because it struck a country considered an advanced industrial economy. Large family-owned conglomerates known as chaebols had accumulated excessive short-term foreign debt. When foreign lenders suddenly withdrew capital, South Korea's foreign reserves were rapidly depleted. By late 1997, the won collapsed, forcing Seoul to seek a record USD 58 billion IMF rescue package. Unlike Indonesia, however, South Korea implemented swift reforms in banking, corporate governance, and labor markets. Public cooperation, including a national gold collection campaign to boost reserves, helped restore confidence, allowing the country to recover more quickly than expected. Lessons for the world. The 1997 Asian financial crisis revealed how quickly globalized financial markets could transmit shocks across borders. Fixed exchange rates, weak regulation, and heavy reliance on foreign currency borrowing proved to be a dangerous combination. The crisis also ignited a long-lasting debate over the role of the IMF, particularly its emphasis on austerity during economic downturns. In the years that followed, many Asian countries adopted new strategies, building large foreign exchange reserves, strengthening financial oversight, and reducing dependence on Western-led financial institutions. These lessons later shaped regional responses to the 2008 global financial crisis and the economic disruptions caused by the COVID-19 pandemic. More than 2 decades on, the events of 1997 remain a powerful reminder that financial growth without strong institutions can turn prosperity into crisis almost overnight.